Good afternoon and welcome everyone. This is Barbara Van Allen, president of the club, and we will get started in actually about 45 seconds. Thank you.
Well, good afternoon and welcome to the 582nd meeting of the Economic Club of New York in our 114th year. I'm John Williams. I'm the chair of the club and president and CEO of the Federal Reserve Bank of New York, and I'm honored to be with you all today. And for those of you in the Northeast, hope you're surviving the 1 to 2 feet of snow. And I guess we got some bad news on Groundhog Day, where it looks like we're going to get 6 more weeks of wintry conditions. As many of you know, the Economic Club in New York is the nation's leading nonpartisan forum for discussions on economic, social, and political issues. Our mission is as important today as ever as we continue to bring people together as a catalyst for conversation and innovation. I'd like to take a moment to recognize those of our 321 members of the Centennial Society joining us today as their contributions continue to be the financial backbone of support for the club and help enable us to offer our wonderful, diverse programming both now and in the future. I've got a friendly reminder, applications for the Economic Club of New York 2021 class of fellows, a select group of rising next-gen business thought leaders, is still open, so please visit our website for more details. We would like to welcome graduate students from Rutgers University and the City University of New York Graduate Center. Now, it's an honor for me to introduce our special guest and club member today, Adena Friedman. So Adena became president and CEO of Nasdaq on January 1st of 2017 and is a member of the board of directors. She brings more than 20 years of industry leadership and expertise and is credited with significantly shaping Nasdaq's transformation into a leading global exchange and technology solutions company with operations across 6 continents. Prior to being named CEO, Adena served as the president and chief operating officer throughout 2016 and is responsible for overseeing all of the company's business segments, with a focus on driving efficiency, product development, growth, and expansion. She rejoined Nasdaq in 2014 after serving as chief financial officer and managing director of the Carlyle Group from 2011 to 2014, where she played a critical role in taking the company public back in 2012. Before Carlyle, Adena was a key member of Nasdaq's management team and played an instrumental role in Nasdaq's acquisition strategy. And since 2018, Adena, very importantly, has served as a member of the board of directors of the Federal Reserve Bank of New York and now chair of our Audit and Risk Committee. Last year, Adena was elected to the board of directors of FCLT Global, a nonprofit organization that researches tools to encourage long-term investing. She earned her Bachelor of Arts degree in political science from Williams College and a Master of Business Administration from Vanderbilt University's Owen Graduate School of Management. So today we're going to have a conversation. I'm pleased to be doing the honors, and we'll end promptly at 1:45. And as a reminder, this conversation is on the record as we do have media on the line. Okay, with that, Adena, let me switch over to this session, the conversation, and so welcome. And you know, one thing that a lot of people, when they think of Nasdaq, they think about .com stock exchange. So could you talk a little bit more about what is Nasdaq? And we talked a lot about technology solutions, and I talked about it in my introduction. So is my view of what Nasdaq is kind of outdated, kind of like my old DVD collection, and I should join the 21st century?
You haven't joined Netflix yet? Okay, well, yeah, first of all, it's great to be here, John, and it's great to have you have the conversation with me, since we do enjoy spending time together in New York Fed. So Nasdaq today is a global technology company that serves the capital markets around the world. So we, of course, bring our technology to run our, for our own markets, and we own and operate one of the largest equities markets in the world. We also own and operate the largest options marketplace in the country, in the US. We own and operate many of the markets in the Nordic countries in Europe. But we also have 2 other parts of our business that have become a very important part of who we are. So the first is we take the technology that we use to power our own markets, and we sell that to 130 other markets around the world. and including the surveillance technology that where we monitor the trading activities happening in our markets. We provide that technology to 50 other exchanges, 12 regulators, and almost 200 broker-dealers around the world. And then on the data and analytics side, we have about $350 billion of assets under management tied to our indexes, and that can be both our benchmark indexes and our smart beta indexes. And then we have a very scaled data and analytics platform that serves the investment management community. So we've become, I think, a much bigger and broader player in the global capital markets than what people, than our roots. And by the way, we launched Nasdaq 50 years ago next Monday. So we will be 50 years old as the first electronic market in the US. But obviously, we've taken that and grown it into a global business.
Well, I will tell you that working remotely has taught me that when the internet isn't working so well, having those DVDs actually has some value. So I do still have some of those. So when we think about the last year and this year, despite the pandemic, despite the recession and everything else going on, I mean, the IPO market has been red hot. We've seen record levels of activity, and apparently, that's continuing into this year. And so, how do you think about what's been happening in the IPO segment? Why is there so much activity, and can you put that into some historical context?
Sure, yeah. So just to give a few stats, so in 2020, Nasdaq hosted 316 IPOs, and we raised $80 billion of capital through the Nasdaq platform, and so we're very proud of that. I think that it was a remarkably busy year, and if you compare that, it's the most IPOs we've had in over 10 years. And when you then unpack that, and I know we're going to talk about this in a little bit as well, of those 316 IPOs, about 184 of them were operating companies that went public, and the remainder were special purpose acquisition companies where they're now looking for operating companies to populate. So I think that it was a very active year, and you can say, well, why would this year of all years be an active capital raising year? And I think that there are a few elements, and I will start with the fact that, as we all know, the government did take very important and aggressive action early in the COVID crisis to stabilize the markets, make sure that the liquidity is functioning well, and then through fiscal stimulus, put more money out into the overall economy, which allowed companies to continue to sustain their operations, but also allowed individuals to manage their lives, including also thinking about how they're going to manage their savings and getting more involved in the markets. I think the fact that as we also know also that with lower interest rates, that it does become more attractive to raise capital through the equities markets. It also, as an investor, it kind of concentrates investment activity into the equities markets because the alternatives become, less earnings generating. So I think that, or investment generating. So we have more of a concentration of interest in the equities markets. And then for companies that were either unaffected by the COVID crisis, such as technology companies, a lot of biotech companies, some companies are actually leaning in and providing services to manage people through the crisis. They were all found actually a very receptive investor audience for those investments. And those were the first that started coming in late April and into May. And then honestly, the risk appetite just became very active among investors. And then, we ended up having a very robust second half of the year.
Now, you mentioned the SPACs. So can you talk a little bit more about that? I think for most people, it's not clear what those are and why they've grown so rapidly. And, this idea of a blank check company probably is relatively new. So could you talk more about what that is and why that's become such a big part of this world now?
Yeah. Well, first of all, these SPACs, which is special purpose acquisition company, they've actually been around for a fairly long time, but they've obviously had this big resurgence in 2020 and into 2021 as well. So far this year, we've also had a very active IPO year. What are they? So basically, a qualified management team, potentially an expert in a particular field or an industry, will get together with investors who who go out and they raise capital into a corporate vehicle that does not have any assets. So it's just it's like a fundraising opportunity. So they use the capital markets, the US, the public markets, to raise capital. And then within 12 to 24 months, they're obligated to populate that company with an operating business. And so think about it as really the operating business being acquired by the SPAC as a way to get into the public markets without a traditional IPO. And so why would a company want to go public that way? I think all the reasons I've heard are, number one, it can actually be faster. So acquisitions are not easy, but they can be done faster. The second is that you get, for the selling investors in that private company, you get certainty of price. So the one unknown that you have when you walk into the public markets through an IPO is what's the price going to be and what proceeds am I going to get? Well, that takes that uncertainty away. And then I think that the third thing is then you also get a qualified group of investors or managers who can help you as a public company kind of make your way into the public markets and act as a public company through the management of the SPAC. So I think those are reasons why companies are finding it to be more attractive. As an investor, you'd say, well, why would you park your money in a SPAC and hope that they find a good business? Well, it's a good question, but if you think about it, number one, there are not a lot of other alternatives that will give you a chance for a return right now, right? So that's the first thing. The second thing is that the investors do have a chance to vote on the deal. So number one, the SPAC itself is liquid. So if they decide they need their money, they can actually sell their shares in the SPAC before it's populated and get their money out. Then when the deal is announced, they get to vote on that deal. So if they don't like the deal, they can either sell their shares in the SPAC or vote against the deal. So investors have a fair amount of control to make sure that they are managing their money appropriately through the SPAC. And so I think that's why it's become so popular.
Yeah, thank you. That was a very helpful background. But, one of the things I think about is when things change really quickly and something like this grows really rapidly, and you hear, I think every day, somebody else saying that they're going to somebody's going to start a new SPAC. It does remind me a little bit, I'm not, coming to conclusions, but it does remind me a little bit of the go-go days of the late 90s where things were moving really fast and markets were growing really rapidly. And how do you, given, your career, you've seen, cycles in Nasdaq over your career. How do you compare these different episodes and how do you think about that?
Yeah, I think it's important that investors always keep everything into context and they think about diversification as part of their strategy, I would have to say. So, I was at Nasdaq in the late 90s. And so I do remember that time very vividly. And I think that at that point, though, there were a lot fewer protections on investors. For instance, I think Reg FD had just come into effect very, very late in the 90s. And so, or even in the early 2000s. So I think that there were certain investor protections that didn't exist back then. I think the second thing was that, as you said, it was the promise of the future, but the actual reality of the companies was, weren't there yet. So here, the companies that are going public are, operating companies going public are in many regards like very good operating companies with solid financials. Now, the great thing about the public markets is you can invest in highly risky stocks or frankly, in not very risky stocks. So you can choose your risk tolerance within the markets. I think that the disclosure obligations are very, very robust in the public markets. So investors have a full set of information. But when it comes to the SPACs, I think that the important thing to think about is how are investors protected? So they're protected in multiple ways. Number one, they put their money into this shell and they can always sell if they just need their money out before they populate. Number two, there's a defined period of time by the time the management team has to find and populate the SPAC or else the SPAC expires. Number three, the investors get to vote on the company and that, what company they're bringing into the SPAC. And so they have more control over that. And then also, if you look at the compensation, one of the things that investors should look at is how does the management team get compensated? And increasingly, they're getting compensated on the performance of the operating company, which I think is also very helpful. So there are a lot of protections that are being put in place, but it is also important that investors educate themselves on what these vehicles are and what they aren't and make sure they're comfortable with them.
So we're going to come back to markets developments a little later, but you said that Nasdaq is fundamentally a technology company, and and you're operating throughout the world. So can you talk, let's just talk a little bit about how technology is changing, in terms of innovation and how that was accelerated or around the pandemic time.
Sure. Well, if you think about the role of exchanges today, and it actually always has been to maximize access and minimize friction. So our job is to make it so buyers and sellers can come together as efficiently as possible, and that we maximize the number of buyers and sellers that are available in the market. So that's a big part of what we do. Well, historically, that was all done through physical means and by putting people on the same room and kind of creating a crowd. Well, I think that today it's all done technologically. And so the engineering challenges that we face as a company today are fundamentally different than they were back in the 90s. We're dealing with up to 62 or more billion messages in a given day being received through our technology. We have to provide, I would say low microsecond latency. So we tend to try to go for sub 30 microsecond latency from when we receive an order to when an execution is sent back to the client. And we also have to scale ourselves. So we might have these surges in activity like we did last week or in March of last year. We have to be able to just, be able to absorb enormous amounts of activity that are coming in. So the engineering challenges are fascinating, honestly. They are just, they're constant and they're changing. And so then you also say, well, what technology is coming that could make those engineering challenges, solve those engineering challenges? And you do start to look at the cloud. What's the cloud meant for is to create almost infinite scalability, where the cloud has not yet kind of gotten to a perfect place is on dealing with it in an ultra low latency environment, but it's getting, it's moving along that spectrum so that getting to an ultra low latency, but also, just infinitely scalable environment is becoming possible. So that's a big part of our journey to advance our technology into the cloud as a market operator. Most of our surrounding systems and other services are cloud-based today. And then I think also machine learning. So machine learning is, a phenomenon that's just getting started. And if you, think about the theory of efficient markets, if everyone has the ability to come up with infinite number of, especially with quantum or something like that, where you have an infinite number of circumstances and you can kind of model them down and find the best path in the market at any given time, through machine learning algorithms, you have the ability to create perfectly efficient markets theoretically. But those are the types of things we think about. And in the early days of machine learning, we're using them more around the protection of our markets and being smarter in our alerts.
Yeah, on this topic that you just mentioned, that the extraordinary amount of trading, the volatility in the markets last March, and then more recently. So when you think about all the remote, the working remotely, all the things that have happened, what's been your biggest surprise about, or kind of takeaway from how this technology has worked, how people have been able to function in this, unusual environment?
Yeah,
and
I mean, certainly within the financial industry, John, I think we talked about this a while ago. If you think about after 9/11 and you think about during Superstorm Sandy, the markets had to close. And frankly, around 9/11, it wasn't because Nasdaq systems were unavailable, but no one could connect. So and if people can get into the offices, they couldn't get to their trading screens and they couldn't trade. And so I think that the reliance on physical location has created challenges for us in two big seminal moments in recent history within the industry. And so on the back of particularly Superstorm Sandy, the entire industry undertook an effort to move everything to a remote environment, right? So we started doing a lot more business continuity planning on taking our entire market ops team and running them out of their house, taking all of tech ops and being able to run everything remotely in a remote environment, taking an entire office location and saying, go work from home for a week. And so we and the entire industry really undertook a huge effort. So when March hit and it was within 1 week, you could see almost all of New York moving to a remote environment. Everyone was ready. It was so much more seamless than you would have expected it to be. So that was my biggest surprise, but in a pleasant way. Now, it doesn't mean everything functioned perfectly. But it was really a remarkable achievement for the industry to do that, because it was so important that we keep markets open, operating, and safe. And I think that the industry should be proud of itself for that.
You know, the term we talk about a lot at the bank, as you know, is resiliency, and this idea of being able to function in any circumstances, and taking the experience of 9/11, from Superstorm Sandy and other experience, and then applying that. It ends up being applied to the thing that probably you or we weren't planning on, the global pandemic, and yet that preparation obviously has paid off. I do think, though, that right now that we have learned also how productive we can be when we work 12 and 14 hours every single day, which is another topic of about. So let me, again, on this issue of, kind of the markets, and one of the things that Nasdaq announced is it would acquire Verafin, firm that specializes in anti-financial crime solutions. So could you talk a bit about why you've done that, and how you think about that fitting into your overall kind of, the market and your strategy?
Yeah, I think a big part of who we've always been and who we are is been really to protect the integrity of the capital markets. That's a big role that we play as a self-regulatory organization, and it's a big role we play as a technology provider. And about a little over 10 years ago, we bought a very small company called Smarts, which that has grown into being one of our larger businesses within our tech division, which provides advanced surveillance technology to help markets and regulators, and now the broker-dealer community, protect themselves and think through, making sure that they understand what's happening in their trading desk or in their markets around compliance with any of the trading rules, market manipulation, insider trading, things that would harm the integrity of the markets. And we need to make sure we're properly protecting the industry in that way. So we've become a very scaled and successful technology provider of these market integrity solutions. So as we think about how do we want to go forward and continue to expand Nasdaq and the reach we have within the financial community, it's very natural for us to want to expand beyond the real-time surveillance and into the broader realm of anti-financial crime, like anti-money laundering, and fraud detection and protection. So we have gone into an agreement to buy a company called Verafin. They provide basically anti-money laundering and fraud detection services to 2,000 banks in North America. And we have an opportunity to bring them into the larger banks and then to go global with their business through our global footprint. And so we're really, really excited about that, and also recognizing that anti-money laundering and market manipulation and other things like that, the banks are starting to figure out how do they want to tie those protection capabilities together and integrate those solutions. And so we think we can be part of that solution for them going forward as we continue to integrate the Verafin and surveillance systems that we have.
And again, this is presumably an area where all these new technologies we hear about play an important role in that. I know that in our discussions around from my position around the world around fintechs and using machine learning and all these other technologies, that's a big part of the story of leveraging those technologies. So I'm going to shift gears again and talk about the board diversity initiative. Late last year, you announced the proposal on board diversity for public companies. So I'd like to hear your talk a little bit more about that decision. What's the timeline on that? Where does it stand? And what kind of reaction have you heard on that proposal?
Sure. Yeah. So first, to level set everyone on what the proposal is. It has two components. First is to create a standard disclosure on the diversity of company, public company boards. So any company that lists on Nasdaq would be required to populate a table every year that provides the diversity characteristics of their board based on self-reported information from the board members. So that disclosure and that transparency to investors is something the investors have asked for many years, and we think it will help in identifying trends and hopefully, positive movement towards more diversity in the boardroom. The second is a standard that we've asked our companies to try to meet, which is to have at least 2 diverse members in the board, and that would be at least one woman and an underrepresented minority on their board. But that's over the next 4 years. But the obligation is, the standard does not require that they achieve that, but rather that if they're not able to achieve that standard, that they then just discuss with their investors, why they haven't yet been able to get there and what they're doing to the extent that they want to share that information. So it's really what we call a have or explain rule. So you don't get delisted if you don't meet the standard, but you do have to share information with your investors as to why you're not able to meet the standard. So in terms of the reaction, so the first thing is on process. It's a proposal that's been sent to the SEC. The SEC put it out for public comment. We've received well over 100 comments, and it's been wonderful to read the comments. They're very substantive. I would characterize about 73 or 74% of the comments have been positive, and many of them coming from the investment community, the companies themselves, and advocacy groups. About maybe a little over 20% are what we would say is negative, and they tend to either come from individuals or advocacy groups that have concerns, and it's good to hear what those concerns are. And then the remainder have been mixed. They might like it, but they want to see the changes to it. So it's great. It's a great process because we get to learn. We will then respond to those comments. Potentially, if we want to, we could make some changes to the proposal, and then it would actually, to the extent we do make changes, it would go out for comment again. So this is a well-known process because once the rule is in place as a self-regulatory organization, it is applied to all companies that list on Nasdaq. I'd say that there are a lot of positives that we've heard from our clients and from the community, but I also think it's important to recognize it's change, and so we have to make sure we're hearing all voices as we think about implementing change.
Have other exchanges done things like this elsewhere, or is I actually don't know kind of what's happened with the others, or is this something you've coordinated, or were you?
Yeah, well, generally speaking, around the world, it's been governments who've taken the stand on board diversity. So in Norway, they were one of the first about 10 years ago. They established a standard that at least 40% of every board should be comprised of women. And so that was a hard mandate, and it was very controversial at the time. I think that they could certainly point to things that it's accomplished in the 10 years since. I think other countries have done more of a have or explain type of model. So, and I think that they've also been effective. So we've been able to see that in other Nordic countries, and then in other parts of the world, so including the Middle East, they're starting to have mandates be put on board diversity. But it's all been done at the governmental level. I think we are the first exchange to choose to do this as part of our listing rules.
And you said the timeline is you're collecting, continuing to collect comments, and then you have to go out for a second round. Is that what you had said?
So yeah, it depends. If we choose to make any amendments, then the SEC would likely put it out for another comment period. I think that there is a defined process within the SEC, and there's defined, timing on when the SEC has to make decisions on certain proposals. But this will happen in a period of months, not weeks, just based on the SEC process.
Great. So coming back to kind of more recent events, markets have been in the news a lot. Some companies that I didn't think people would be talking about, like BlackBerry, are in the headlines every day. So can you give your kind of from your vantage point, having watched markets over decades and importantly, seeing the technological change. You mentioned that Nasdaq started almost 50 years ago, and there's been a lot of technological change for that, but we're now seeing that in terms of other platforms. So could you comment, at least from your perspective, how you view the developments we've seen in the markets in the last few weeks?
Sure, yeah. I think it's good to put it into some context. So Nasdaq, the entire purpose of Nasdaq has been and will always be to democratize access to the market. So, and I came into Nasdaq in 1993. So right as the retail internet brokerage community was getting launched. And it was amazing, honestly, at how it empowered investors to access the markets and to have more control over their own savings. And I think that really gave rise to a whole new way of thinking about the markets and access. So So we've always been huge advocates of that, and including the current modern retail online brokers. They're an important part of the ecosystem, and they provide access to hundreds of millions of people into the markets, which we see as a good thing. I think that another part of our role is, of course, to maintain the integrity of the markets and to make sure that they're fair and balanced, and making sure that every investor gets access to information about a company at the same time. That's a big part of our authority, and as a listing market, is to work with companies around reporting news and managing activities in their stock. I think that but our primary purpose is to allow buyers and sellers to come together. And there are going to be periods where there are more buyers and sellers, and there are periods where there are more sellers than buyers. And our job is to allow for a liquid access. That's our job. And so we take it very seriously. In this particular case, we had a phenomenon that a lot of us didn't understand right away because it was happening very quickly, where there were retail-oriented chat rooms that were starting to galvanize investors to go and buy a certain company. And generally speaking, what I would say is, companies that had had a fair amount of short positions in them. So, professional investors were generally showing that they were betting against the company through their short positions. These retail investors kind of came together and said, let's become buyers. And so they basically crowded their capital together to buy the stocks, and they created this giant one-sided trade. And so that has consequences. So the first thing is, we just all have to understand what's the nature of that activity. And I think the SEC in particular will be looking at that and examining, is that activity just a spontaneous group of unconnected people, or is there some sort of coordinated or concerted effort in that kind of activity? That's something that they'll look at. And then the second thing is to make sure that the brokers have enough capital to manage those positions that they're taking on in their system. So the brokers are members of, or they use members of clearinghouses, and the clearinghouse in the US is DTCC. So when you take a huge long position and you've got a crowdsourced long position in a stock, and the stock becomes very volatile, that changes the capital requirements that the clearinghouses place on those brokers, because the trade doesn't settle for 2 days. So that 2-day risk becomes pretty big. If it's a highly volatile stock and you've got a really long net position. So, the online retail brokers were facing a situation where they had to potentially limit access to their investors to allow them to continue to buy and increase that position, or they had to put up more capital. And so you could see where they, in some cases, had to restrict some access while they raised the capital to be able to meet the capital obligations that DTCC was establishing. That is just how the markets work to create safety and resilience and risk management. But it's a part of the market that people don't understand very well. So I think that generally you've seen them put up the capital, they've made the trading available, and the investors are expressing themselves how they wish. But the one thing I would just say is, there are rules that govern our markets, and people will be examining the behaviors to make sure that everyone's following the rules in the process of doing these trades.
Well, it's another example of how, technology has transformed how how information is transmitted. The people, going back to, the news, people are not perhaps reading newspapers and watching the 6 o'clock news as much. They're getting it through social media or other online sources. Similarly here, I think the surprise may be that just how much that, information is flowing through, maybe you could think of this as non-traditional ways, but perhaps there are going to be more traditional ways of how people act and communicate.
Yeah, and I think the issue is that there are, one of the things that, since I've been in the markets as long as I have, we've seen a lot of different behaviors. And so way in the 90s, a long time ago, we would see concerted efforts by brokers to try to drive investors into stocks. The brokers would take a position early, they'd drive up the stock, they'd sell the position, and they'd leave the investors hanging. I think about that, and I want to make sure that all investors just understand and are fully informed on the risks they're taking, but also on making sure that they think about this as their savings. So as they're putting their savings to work in the markets, are they understanding the risks that might come in? But those are, old memories. The question is that really what's happening here, or is it really just truly a spontaneous group of investors deciding to stand up and take a position. And I think that's that's something that we'll learn more about over time. But in the meantime, I think it's great that we give access to hundreds of millions of people. I think it's important that every investor educate themselves on how best to leverage the markets.
So going back to how technology is transformed, whether it's in stock exchanges or financial markets or the other areas, what do you see as the biggest kind of new technologies or way technology is going to transform, whether it's your business directly or more generally? What is the next big thing?
Well, I think the thing that everyone likes to point to, because it's so fun to think about, is quantum computing. And it is actually important to think about. I do think that the notion of a quantum computer, the power of a quantum computer, is becoming a reality. And you could look at, you've seen these experiments that Google and others have done to show and prove out the notion of this, just what I'll call hyper powerful computing capability. When that becomes a mainstream part of the economy and the markets is another question that I don't think any of us can answer right now. But we do think about it, because when we think about our job, which is to protect the markets and maintain the integrity of the markets, and we provide advanced technology to do that incorporates machine learning into it to help manage the risk that people are taking on in the markets, I think it takes it to a totally different level when you think about quantum computing. So staying ahead of that trend, being engaged with those companies that are on the forefront of that technology is an important role that we play to make sure that we can be an early adopter and bring that into the industry from a protection perspective. And obviously also from a computing power perspective, and making sure we can continue to scale the capabilities of the markets to accommodate that type of technology. I think the other thing that people really focus on is the security and IT security elements that might be challenged with a quantum environment, and making sure we're upping, the whole IT security industry is upping their game to prepare for that type of technology coming in. And that then goes to the digital certificates and digital asset world, where the security of that type of code, the question is it going to be protected enough when you think about the power of quantum to be able to basically break codes and basically infiltrate systems and infiltrate software. So I think that's the one that we all should be really starting to have a concerted conversation around to understand how it could impact markets going forward. But it could be 20 years before that hits the mainstream. We never know.
So you said that you're about to have your 50th anniversary for Nasdaq. Is that right?
Yes.
So
on next Monday. Mm-hmm.
All right. Okay. Well, congratulations. So when you think about the changes that have happened with Nasdaq, we've talked about them, starting electronic exchange, being a technology company. I mean, if you were to jump 50 years ahead, I mean, what do you think the next 50 years are going to be like? I think you've already talked about that with quantum computing.
So I should probably make sure I think about that answer. That'll be a common question. I mean, what's been fun to see over the last 50 years, could we ever have pictured the level of technology and how it's influenced our lives, and the ease in which we get access to information, and the ease in which we communicate, and the size and scale of the markets and how big and broad they are today? I'm not sure in 1971 anyone could have predicted that. But what I do think that we can be sure of is that I believe that the markets do serve as a critical center. There is a natural reason why markets exist, because there's an inefficiency that if you decentralize the markets, then you would have what I would call, kind of a time issue between the buyer and the seller. Buyers and sellers, they want to find each other, but they may not want to find each other at the exact same moment. So markets provide that critical role of that instantaneous access to liquidity in an environment that is as fair as possible. So I think they'll persist. So that's the first thing. Markets will still be here in 50 years. I think the second thing is it's a global world out there. And the question is, over the next 50 years, do we find barriers breaking down where more and more trading can be done? I mean, trading is done globally, but I would say markets continue to be very domestic. And so is there more of at least a technology fabric that ties markets together think the cloud is a big part of that. But I also think that, changes in the way that the world thinks about itself, the global economy versus national economies. In the next 50 years, if the economy really were to become a global economy, that gives rise to a whole new range of things that exchanges could do together. So those are the types of things I think about over the next 50 years.
Terrific. And, you will not be surprised to hear that economists, when we write down our models, we just write a sentence that says, assume there exist markets that clear all prices clear all markets and settle prices in equilibrium, and then move on. So that's how we do that.
Like an underlying economic assumption. I like that. That's good.
Assume a can opener. So last question. You said I asked you about 50 years ahead and thinking about that. What about 2021? 2020 was a eventful year. What keeps you up at night? Now it's February 2nd, 2021.
I have to say, every week it's felt like a month this year so far. But I think that it's a very fast-moving environment right now. So I think making sure that we are meeting the needs of the market, that we continue to be as resilient as we have been. Those are the table stakes, and those are the things we focus on each and every day. I think as I think about the broader picture and just making sure that the vaccine rollout is smooth and effective and successful, because it's the only way that we're really going to find ourselves comfortable getting back together and starting to have the spontaneity of in-person conversations and having the creativity that comes with that. And frankly, having the economy come back to life and allow ourselves to have experiences again, and to be global. We can't even travel, so we can't even see or go places. And I think that's a big part of gaining understanding and being a global citizen. So I'm excited for that, but I think what keeps me up at night is just making sure it actually proceeds the way it should, so that we can get back to whatever normal is going to look like.
Yeah, well, I agree with you. We're all looking forward to the complete successful vaccination and being able to get back to normal. Well, I see my job is to make sure we are run on time. I see that we are right now out of time. So Adena, thank you so much for giving us the look back 50 years, what's happening the last week, and then the look ahead to the next 50 years for Nasdaq. This has been a terrific conversation. Thank you so much for joining us today.
So much, Tom. Thank you.
Great. Well, I'm going to close now with what I always close with, that we've got a whole bunch of speakers lined up. 2020, we had a record number of events at the club, and it looks like we're trying to break that record in the first half of the year, the way it's lining up. So let me just give you a couple or several that are coming up soon. So on February 10th, we have Jay Powell, the chair of the Federal Reserve System, of course, speaking at the club. And then we've got on February 12th, Peter Orszag, Bob Rubin, and Joe Stiglitz will be at the club. Then on February 17th, we have Mark Tessier-Levine, president of Stanford University. And then on March 2nd, we've got Mary Daly, president and CEO of the Federal Reserve Bank of San Francisco. And then looking further ahead, we've got on March 11th, we have Citi CEO Jane Fraser and GM CEO Mary Barra joining us for conversations. And we're working hard on those 12-hour days to lining up more and more events for you. So please keep tuned to your emails that we send out and watch our website for more announcements. So everybody, thanks again for attending today's event. Please stay healthy and safe.